Hey there, welcome to the Reinsurance Podcast, the place where we dive into all things reinsurance, the coolest part of insurance. We're your hosts, Jared and Ben, a couple of ex-practitioners who loved the industry so much we founded Supercede to tackle some of its biggest headaches. And we're here to share our insights and stories with expert guests as we uncover what's really going on in the industry.
Welcome back, everybody, to another special Monaco edition of the Reinsurance Podcast. Delighted to welcome Sunnie Luthra, the Managing Director of Leadenhall Analytics, who's going to talk to us about all sorts of topics, not just analytics, but the market as well. But first, Sunnie, maybe could you introduce yourself and let us know how you found yourself at Leadenhall?
Brilliant. Thank you so much, Ben, for inviting me to the podcast. Really good to be here. So Leadenhall Analytics came around primarily driven by the patterns I was seeing in the market, and they were primarily around the MGA market. So, as you've seen, the MGA market is booming. There's lots of MGAs out there, and that I think is one of the areas which is relatively underserviced by the analytical services. Mostly what happens is, you have a couple of underwriters, they get together, they want to set up an MGA, they got access to the business, and they want to go ahead and do that. Now, what normally ends up happening is that is all fine for the first couple of years. Then comes 2-3 years period, after which their profit commissions will be paid out. And that's where at that time, they have to rely a lot on the capacity actuaries. Yeah. They are going to set the reserves. They are going to set all the assumptions around the reserves. And as underwriters, you can challenge a bit, but not as much. And that's where I was seeing, some of my friends who were underwriters, struggling with that. And it's like, that's an interesting area that is not serviced well. And maybe we can do something for the market. Yeah. And we started with one of our first clients. We took on board, we helped them significantly. I think they were struggling to retain the capacity, and then we came in and did some work, which ended up them renewing the capacity. So that opened up my eyes effectively. It's like, okay, there is a value that as actuaries we can add to that market. Now, obviously, the big challenge always is that the budgets are constrained, so they cannot afford the big consultancies, and that's where we come in and say, right, we are here for you as your partners, and we're not here for the short term, that we come in, do something for you, and then move ahead. We want to be with you in your partners in your success journey. And amazing. That's how we structure all our remuneration around it as well. Oh, so that's how Leadenhall Analytics came around. I mean, I've got a lot of experience of insurance, underwriting, working with the underwriters. In my past, I've done capital work, reserving work, some bit of pricing, a lot of exposure management. So it helps bring all of that perspective together when you're working with the underwriter.
Absolutely. And do you guys have a geographical focus or sort of more international, global?
It's initially, currently our focus is London market.
Okay,
so we are working with the clients who are based in London market, working with Lloyd's capacity or non-Lloyd's capacity, but London market. So we have not expanded outside yet because we want to focus in the area which is the mecca of insurance.
Yeah, makes sense. And it's mainly MGAs, small brokers, these kind of.
That is the idea so far.
And what do you equip them with when you work with these folks?
So there's a few things. So first is we will come and help them understand the portfolio.
Okay.
Right. Yeah. So as underwriters, they're extremely efficient at knowing what risk they're writing, what is happening. But because they're also doing so many things, one of the things that always get lagged behind is how to improve that portfolio. They have that portfolio, they've been writing it for a while, so they have a very good idea. Yeah. But that was when they were in a big shop. Now they have set out on their own. The portfolio is changing. Absolutely. And some of the portfolio will not follow them, some of the portfolio will follow them. And how do they make good understanding of how much risk they're taking on, how much are they passing on back to the capacity, how much improvements they can make on the individual underlying risk. Yeah. One example, so normally the underwriters get shown 3 years of data, 4 years of data, and you make a decision. So if it's a recurring account you've been writing for a long time, you have a very good idea. If it's a new business you're seeing, and you only get shown 3-4 years of data, you actually do not know what was in the history. Yeah. And as underwriters, they're not geared up to do that either. So that's where we have come in. We've come in and helped some of our clients to actually not just look at 2 years, 5 years, 10 years data, 15 years data, whatever data is available, and start making sense of it. How many times a client has been the bad egg, right? Has been passed around for a while, but then they become good egg for 3-4 years, goes to a new underwriter, bang, big loss, and then again the cycle starts. So that's where we have come in and helped, effectively saving them a lot more money than they will have to pay us in fees. Effectively, make ourselves free. That is the idea. We do not want our clients to pay for us. We will make sure that we are able to improve their profitability, that it pays for us.
Oh, amazing, super exciting. So I guess you're here at Monte Carlo to share that narrative and find more clients, or are you seeing existing clients? What's the main goals for you as you go around this very sunny and interesting place?
Being very honest, the main goal has been just to see how the market is.
Yeah.
As an actuary, having worked in traditional roles, we end up going to the insurance conferences, the actuarial conferences, and obviously you see the underwriters, the senior execs all going to Monte Carlo, and I've always had this excitement, like I want to see what it is. But it's been very fruitful. Actually, we've met a couple of really interesting potential clients.
Very cool.
So things are looking interesting. But again, for us as well, because we are growing at the moment, I am not very keen on just going out and doing a big bang, because I want to focus on our strengths, which is we are still agile, we're still nimble, and we can work with selective clients to start with, and then as we expand, as we make sure the services are the right ones for everybody, then we expand. So I'm not very keen to massively expand initially.
Happy customers leads to more happy customers, right?
Indeed, that is the whole idea. I mean, the whole idea is, so far all our customer base, it started with one, and so far where we are, it's all been because of recommendation.
Great, okay.
So we have not really actively gone out and sought people that we want to do something with you. It's always been our friends have recommended us to somebody else.
Yeah, you have to watch out now. You've been on the Reinsurance podcast. You might get a ton of inbound that you'll have to respond to.
That'd be amazing. That'd be amazing. The more we see, the better it is, I think, end of the day.
No, definitely. And so in your sort of mission to make sense and catch up on the latest and greatest gossip, etc. at Monte Carlo, what have you heard? What are the main themes that have caught your eye this year?
I think the main theme which has caught my eye is the US casualty, which again, there are few lines of business which I'm scared of. Personally, I've always been scared of. US casualty was one of them. Political violence is another one of them, and cyber risk is the third one. So these three have always scared me.
What a year for those three to come together, isn't it?
It's like all of them have come together in the same time. So the US casualty is definite. I mean, all three are now big on the agenda for everybody. And I think people have started to realize, because a lot of growth happened. So the market hardened 2-3 years ago, and a lot of growth was coming in from these areas, and so NatCat and casualty were growing significantly. Double-digit rate increases, and you suddenly get an influx of people want to buy these products. And my worry was that, did anybody at any point took a step back and thought, okay, why is it happening? That suddenly it is the rates were depressed for so long. Now suddenly you are seeing 20%, 30% year-on-year increases. Just putting my analytical hat on, if the prices were 100 at one point where they were sufficient, they had been going down to 10, and now you're suddenly seeing a lot of rate rises. Now they're up to 50. They're still way lower than where they should have been. But because they were 10 and now they're 5-fold higher, suddenly you have comfort around it. I mean, that is something which I've always failed to understand.
All of the underwriters listening to this are cheering you on. They go, keep going, Sunnie. You tell the brokers.
The broker's job, see, broker's job is very delicate. And as a broker, you are acting on behalf of your client, and the client is a cedent. So you need to get the best deal for your cedent. At the same time, you do not want to upset the markets who are going to provide the insurance. So they have a very delicate act, and absolutely love the brokers. They're doing a fantastic job in terms of not just making sure the insurers are on side, but also getting the expectation of the cedents right. And as somebody told me, so last 10 years was continuous soft market, and there were a lot of brokers who came in at that time who had always seen a soft market. So rates would, they will always can go back to their clients and tell them, I got your discount, discount. And how the message had to change to go back to the cedents and say, actually, it's now going up.
Is that changing the value proposition of the brokers? Are they having to bring something different to their clients if they can't keep on saying, look, I got you a discount? Do you think, is that maybe on the analytics side nowadays? Or?
It is, and it's an interesting point you said. I mean, we're helping a broker at the moment where, and I think for the first time I was looking at from a cedent's perspective. Normally as insurers, you end up seeing, right, this is my deductible, this is my threshold. Above that, I'm covering. So I only care about that. I do not care about what is happening at the bottom. Now, if you turn it around for a cedent, they care about that. They care about that because I hope they will be paid out. But that's what they care about. And actually, if they're not careful, they could become insolvent very quickly. Even if they're not insolvent, they may become illiquid, and the insurance, we do not pay out immediately. We all know that. There's a process, it takes time, and by the time the money will come, would the company or entity still be in existence? So that is where I think the brokers are already adding a lot of value, and I think they should be adding a lot more value to the cedents. Alongside, they should also be adding a lot more value to some of the MGAs, like we keep saying, right? So MGA market which is booming. They do not have big actuarial teams. They do not have the big analytical teams sitting behind them. So that's where the brokers actually come in and add value, where they can say, right, okay, we've done this, we've looked at this risk, this is what it looks like, and you get some comfort around, as an underwriter, get some comfort around what risk you're taking on. But at the other end as well, as we all know, brokers are acting on behalf of the client. So as an underwriter, I'm not trying to make any enemies here, but underwriters inherently do not blindly rely on brokers, right? They have their own view. They know who they're dealing with because they have dealt with them for so long. So they need to have their own comfort factor of what risk they're taking on.
Makes sense.
So that's where I think the brokers are, and the underwriters keep playing the dance.
Yeah, it makes complete sense. And then on the other side of the equation, one of the things we were talking about before we got started was the lack of new entrants again, I guess, or the lack of successful new entrants. And you had quite an interesting theory as to why we weren't seeing much new startup capital coming in.
I'm just trying to connect the dots here. When I was saying earlier that, so you go to some of these briefings and they're saying nobody's seeing a class of 2004, despite all the capacity being available. And I personally think it's purely down to the class of MGAs that have come up. So take a step back 20 years ago, right? When the only option for the underwriters were you either go and set up your own company if you're very entrepreneurial, or you go to a new bigger shop and get more money out of that. So the MGA idea was maybe existed, but it was not really mainstream back in the days. Whereas now the MGA idea has purely become mainstream to the point that most insurance companies have an MGA strategy. They have a separate division, which is delegated authority division. They call it MGA division, cover holder division. This all the same thing, and where they are actually actively looking for the risks or the MGAs they can back. Again, it works both for the insurers, reinsurer, and the underwriters, because I always use this example. Back in the day, as an underwriter, you don't like where you are, you go to a new shop, then you wait for 2 years to get all the book back. And after 2 years, you've got the book back and some more, and then a few years down the line, you want to change again, you have to repeat the whole process again and again and again. Whereas what is happening now is the underwriters, they come out, the good entrepreneurial underwriters, they get the backing from a capacity, so it takes them some time to bring the book back. But once they've got the book back, it's their book now. So the capacity providers are an important stakeholder, but they're not the only stakeholder anymore.
Absolutely.
So, and that applies to the insurers as well, that they would want to back certain underwriters. Now the strategy has changed. They do not want to support this line of business anymore. It's a 1-year contract, just like insurance. They stop, they run off the book, and then both can part ways amicably. And then similarly, another insurer might want to start participating in that line of business. So rather than hiring an underwriter, setting a staff around them, setting up the whole function, they can actually just back an MGA, see how it goes for the first few years, and if they really like that book of business or that line of business, then they can set up their own, or just continue backing the MGA. So we've actually, I think we are seeing now certain insurers who are coming out their strategies only to back MGAs. Carbon is an example where they only write MGAs.
Yeah, I know what you mean. It's an amazing sort of dislocation, I guess, or even sort of separation of the different chunks of the value chain, isn't it? That's actually coming real around us. But no better place to witness it than here in Monte Carlo, I think.
Absolutely.
Yeah.
I think Monte Carlo is a lot. So, the theme has been, you start your reinsurance renewal discussions. But if you go around and even just look at the attendee list, you see there are a lot of MGAs who are here.
Yeah.
Now, they're not here to buy their reinsurance. They're here because everybody's here.
Yeah.
They can actually end up meeting a lot more potential capacity providers, and see what all products they can launch with different people.
Yeah.
Because again, one of the risks the MGAs carry is what happens if my capacity provider withdraws.
Yeah, completely.
And some of the MGAs are mitigating that risk by not relying on just single.
Making sure they have plenty of friends.
They have a panel. They have. I was speaking to someone and they said, ideal number of capacity providers they should have is 7.
Yeah.
If one goes out, they still have. It's easy to replace 1/7 than 50%.
Completely.
Or 100%.
Yeah. Oh, amazing. Unfortunately, we are running low on time, so I have to ask you for any final words you'd like to share with the audience of the Reinsurance Podcast Monte Carlo edition before we wrap up.
So the things I would like to share definitely is that the market is dislocating. There are so many opportunities here, and it's very easy for both the insurers and reinsurers and the MGAs and all of them to think that anybody will get a capacity. That is not true. You really need to have a strong proposition, because for MGAs there are a lot of capacity providers looking for new opportunity.
Yep.
For the capacity providers, there are tons of MGAs knocking at the door. It's about getting the right balance and the right fit. Never underestimate the role of a broker. The tendency normally is to cut the broker away from this process and just directly go to the capacity provider. I would always caution against it. Brokers are very important in this value chain, and they should be respected for the work they do.
Well said. Wise words. Sunnie, it's been a pleasure having you on the show. Thank you, and enjoy the rest of the conference.
Thank you so much. Good to be here.
Thanks.
Thanks for tuning in to the Reinsurance Podcast. If you enjoyed our show, don't forget to subscribe wherever you get your podcasts and leave us a review to let us know how we're doing, preferably 5 stars. For more insights and updates, follow us on LinkedIn and visit our website at supercede.com/podcasts. You'll find the links in the show notes.